All right, welcome to The Explainer. Today, we are digging into a real giant of Canadian finance, Power Corporation of Canada. Now, the big question on everyone's mind is this a hidden value gem or is it one of those complicated beasts you should just stay away from? Well, we're going to find out. And really, this is the question that matters most, isn't it? Everything we're about to go through, all the numbers, all the analysis, it's all designed to answer this one thing. Can you, as an investor, realistically expect to get a 9% return from this stock over the long haul? So here's our game plan. We're going to start with the basics. What is this company? Then we'll do a deep dive, check out the financials, look at the good, the bad, and the ugly. And finally, we'll figure out what's the right price to pay. Let's get into it. All right, first things first. What exactly is Power Corporation? It's not as straightforward as you might think. So here's the deal. Power Corp isn't really a company that does one thing. It's more like a parent company, a holding company, to be exact. It owns big chunks of other huge financial companies like Great-West Lifeco and IGM Financial. So it's not making widgets, it's making money from insurance premiums, fees from managing assets, all that good stuff. It's basically a financial services empire with a focus on North America and Europe. And this structure, being a holding company, is a real double-edged sword. On the plus side, you get money coming in from all these different places, which is super stable. But the downside? Man, it can be complicated for investors to understand. And because of that complexity, these kinds of companies often trade at what's called a conglomerate discount, meaning the stock price is actually lower than what all its pieces are worth. We'll talk more about that later because it's a really key point. Okay, so we know what it is, but does it have an edge? Does it have what Warren Buffett famously calls a moat to keep competitors at bay? Let's dig in. The verdict is a decent moat, but not a massive one. I'd call it moderate. Its strength comes from being absolutely huge, right? Plus, insurance is a tough business to get into, and once someone is your wealth management client, they tend to stick around. But, and this is a big but, that moat isn't impenetrable. You've got fintech startups nipping at their heels, and the whole world is shifting towards cheaper, passive investing. Those are real threats. And who's steering this ship? Well, it's been the Desmarais family for a long, long time. And their style is pretty well known. They're competent, they're conservative, and they are all about the long game. Don't expect any crazy, risky moves here. They're playing for keeps, not for a quick buck. All right, so we get the business model. We know about the management. But what about the money? Does the story hold up when we look at the financials? Let's pop the hood and see what's really going on. Wow. Okay, first up, look at this number. Over $5 billion in free cash flow every year. This company is an absolute cash machine. That is a massive, massive strength, and it's really the foundation of why anyone would even consider investing in it. And here's the twist in the story. For all that cash it's generating, its return on invested capital, or ROIC, is incredibly low. We're talking less than 1%. Basically, ROIC tells you how good a company is at making a profit from the money it invests in itself. And a number this low? Yeah, that's a big red flag. It's something we have to figure out. So here you have it, the big contradiction of Power Corp. On one hand, tons of cash flow, a low price tag, and margins are getting better. Awesome. On the other hand, that terrible ROIC, meaning it's not great at using its capital, and revenues have actually been shrinking. This right here is the puzzle you have to solve as an investor. Okay, so with this mixed bag of financials, what does the future hold? Let's start weighing the possibilities, the good and the bad. This chart really helps put things in perspective. You can see how we've weighted everything. That strong cash flow, yeah, that's the heavyweight champion in the pro column with a 25% weight. But look at the con column. That low ROIC we keep talking about, it's a major drag, pulling everything down. And this brings us back to that idea I mentioned earlier, the conglomerate discount. This is super important. It's the market basically saying, hey, this company is too complicated, we're worried management isn't using the money efficiently, so we're just going to value it less than its parts. And for a value investor, that discount, well, that can be where the opportunity lies. So let's play out a few what-if scenarios. In a bear case, if things go south, maybe the stock's only worth about $60. But the base case, what the analysis sees as the most likely outcome, puts the real intrinsic value at around $82 a share. And if things go really well, we could be looking at over $100. All right, enough theory. Let's talk brass tacks. What is the right price to pay for this thing? So, when you crunch all the numbers using a couple of different models, the analysis lands on an average intrinsic value of $81.80. Let's just call it 82 bucks. That's our fair value estimate. Okay, and here it is, the answer to the question we asked right at the very beginning. If you want to make a 9% annual return on your money over a long time frame like 16 years, you've got to buy this stock at $63 or less. It's just math. If you pay more than that, hitting that 9% target gets really, really tough. So, right now, the stock's trading at around $66, and our fair value is 82. That gap between the price and the value is what value investors call the margin of safety. In this case, it's about 20%. Now, is that good? Well, it's adequate. It's not a screaming bargain, where you might want to see a 30, 40, or even 50% margin of safety. It's okay. So, we've looked at everything: the business, the numbers, the risks, the price. What's the final verdict? Let's tie it all together. Here's the investment thesis in a nutshell. What this stock is: it's a conservative, steady Eddie, income-focused compounder. What it is not: a high-growth, shoot-for-the-moon investment. The whole case rests on three pillars. It generates a boatload of cash, its companies are dominant in their fields, and it trades for less than it's worth, which lets you collect a nice, steady dividend. And this quote really says it all, doesn't it? To get that 9% return, you want to buy in at around $63 or less. At its current price, it's pretty fairly valued, maybe even a little bit undervalued. But it's not a slam dunk, back up the truck kind of buy, at least not if your goal is a 9% return. So there you have it, a complete breakdown of Power Corporation. I hope that was helpful. Now I'm curious, what do you think? Is this the kind of stable compounder that has a place in your portfolio? And more importantly, what company should we break down next? Let me know in the comments below. I read all of them.